picture this. You are standing directly underneath the thrusters of a Saturn V rocket right at T-0. The ground is violently shaking beneath your boots.
Boy.
Yeah, the noise just pushing the air right out of your lungs. And as you look up at this towering machine lifting off the pad, you really only have one single thought. Is this massive structure going straight to the moon, or is it going to violently detonate before it even clears the launch tower?
That is a terrifying visual, honestly.
Right. But welcome to the special time and market deep dive. Before we check the telemetry on this one, standard operating procedure requires a really quick reminder. This discussion is strictly for entertainment purposes only. You should always, seek professional advice before making any actual investment decisions.
Absolutely. But I have to say, it is the ultimate high-stakes environment right now, and that launch pad scenario, that is the perfect framing for the entire semiconductor industry at this exact second.
It really is.
You're watching these companies just completely defy the standard laws of financial gravity. And I mean, everyone is just holding their breath, waiting to see if the structural integrity is going to fail.
Exactly. And today, we're aiming our telemetry entirely at one specific rocket, and that is Micron technology, ticker symbol MU. We have a massive stack of data to get through today to figure out if this structural integrity holds up.
We really do. What's on the docket?
So we're pulling directly from Micron's latest financial results, their 2025 sustainability report. We've got live market data from Robinhood and MarketBeat, a deep dive industry analysis from TrendForce, some competitor metrics from Benzinga, and, my personal favorite, a fascinating and highly contentious debate currently tearing apart the R-value investing subreddit.
Oh, the Reddit debates are always spicy.
They are. Our mission today is to cut through the relentless semiconductor hype and figure out if Micron's current trillion-dollar valuation represents a permanent, AI forever paradigm shift in the market, or if we are staring blindly at the absolute peak of a classic, brutal boom and bust memory cycle.
It's the trillion-dollar question.
Okay, let's unpack this.
Yeah.
Because to really understand the severity of that question, we have to look at the sheer velocity of what Micron has achieved over the last year. I mean, you do not just stumble into a $1 trillion valuation.
No, you definitely don't. It requires an insane amount of momentum.
Right. And looking at the Robinhood data, Micron's stock has been moving at literal escape velocity. Right now, it's trading right around $969 per share.
Which is just a staggering number on its own.
The performance metrics are bonkers. It is up roughly 214% year to date. And if you look at the past trailing year, it's up an astronomical 859%.
Wow, over 800% in a year.
Yeah. That run is exactly what pushed them over the threshold into the exclusive $1 trillion market cap club. And what's crazy is that it's not just like retail hype driving the stock. Their underlying financials for fiscal year 2025 were just record-breaking across the board.
They actually have the numbers to back it up.
They do. Revenue grew by nearly 50% year over year, hitting $37.4 billion.
But, the top-line revenue isn't actually the most important data point in that earnings report, in my opinion.
No.
No, it's the fundamental shift in the composition of their business.
Ah, right. The data center dominance.
Exactly. Data center revenue now makes up 56% of their entire operation.
Wow, over half.
Over half.
Yeah.
Their combined revenue from high bandwidth memory, or HBM, along with high-capacity DIMMs and LP server DRAM, hit $10 billion.
$10 billion?
Yeah, that is a five-fold increase from the previous fiscal year alone. And as they scaled that revenue, their gross margins expanded by 17 full percentage points to reach 41%.
41% margins on hardware. That's wild. I know a lot of people like to use the old selling pickaxes and a gold rush analogy here, but that feels way too simple for what is actually happening with Micron.
It is way too simple. We really need to abandon the pickaxe metaphor completely because it fundamentally misunderstands the actual technology.
Oh, so
what's fascinating here is that when we talk about AI inference use cases, things like vector database indexing or large language model processing, these systems demand a completely different architecture.
Right. It's not just a standard upgrade.
Exactly. Standard memory is kind of like a sprawling one-story logistics warehouse. Data has to travel horizontally all the way across the floor to get to the processor, which obviously takes time and it takes energy.
Right, which slows everything down.
Yeah. But high bandwidth memory, or HBM, takes that entire warehouse and literally stacks it 12 stories high. It places it directly next to the processor, and it punches millions of microscopic pathways straight up and down through the silicon.
So the data travel time effectively just collapses.
Precisely. It is vertical stacking, and the engineering precision required to manufacture a 12-layer vertical stack without any microscopic defects is brutally difficult.
I can imagine.
Because the manufacturing is so incredibly complex, the yield rates are inherently lower.
Yeah.
You are literally throwing away more silicon just to get one perfect stack.
Which obviously drives up the cost.
Exactly. But because it is so hard to make, and because NVIDIA desperately needs it for their GPUs, the successful HBM units command massive premiums. That structural difficulty is exactly why Micron's margins jumped 17%. They aren't selling pickaxes. They are selling highly bespoke, precision-engineered compute bottlenecks.
Man, I love that framing.
Yeah.
The Q bottlenecks. But knowing all this, the stellar performance, the huge margins, the highly complex product, we run headfirst into a massive valuation anomaly.
Oh, yeah. The valuation is where things get weird.
Really weird. This is where the market data gets incredibly messy. If we look at market beat, Micron's trailing PE ratio is sitting around 43.6.
Okay, which is rich, but honestly totally standard for a hypergrowth tech stock.
Sure, but then look at the forward PE. It's sitting at 9.6. And their forward PEG ratio is practically non-existent at 0.07.
See, a forward PE of 9.6 on a trillion-dollar tech darling, that is the market aggressively flashing a warning sign.
It's totally schizophrenic, especially when you compare to the historical data. Micron's 5-year average PE usually hovers in a much different territory. It adjusts wildly based on where they are in the memory cycle. But right now, you have analyst sentiment on Robinhood, where 92% of analysts give it a pounding the table buy rating.
92%? That's huge.
It is. Susquehanna just raised their price target to $1,750. UBS bumped theirs to $1,625.
There's some massive upside projected there.
Right. But then you look at the average consensus price target among the 39 analysts tracked on MarketBeat, and it is lagging way behind at $595.63.
Wait, which is roughly a 38% downside from current trading levels?
Exactly. I'm looking at a company with 900% EPS growth projected for the next quarter, and half the market is pricing it like a distressed asset. So to make sense of that $595 price target, I dug into the 10-year discounted cash flow models that a lot of these more conservative analysts and value investors are using to justify that lower number.
Oh, the classic DCF. The DCF models are where the narrative really breaks down. Walk us through the math they are actually using there.
Okay, so if you run a standard 10-year DCF analysis using Micron's current free cash flow base, these models are typically projecting a 9% growth expectation over the next decade.
9%. Okay, a pretty modest baseline.
Very modest. Then they use a standard 2.5% terminal growth rate. That essentially assumes Micron grows just slightly faster than global GDP in perpetuity after year 10.
Right, standard value investing practice.
Exactly. And then they discount all that back at a 10% discount rate. When you calculate the final intrinsic value using those specific inputs, the model spits out a fair value right around $600 to $650.
Ah, and suddenly that $595 market beat consensus makes perfect mathematical sense.
Right. From a pure, strict value investing perspective, you have to look at the final verdict. At $969 a share, the stock is trading at a massive premium to its calculated intrinsic value. So the DCF practically screams, sell, or at least a firm hold, avoid buying at this level, while the Robinhood analysts are screaming buy.
It's a completely split verdict.
It really is. But my main issue is the inputs on that DCF. How can anyone justify modeling a 9% growth rate over the next decade when EPS is literally jumping 900% next quarter? That model feels like it is completely ignoring the AI supercycle.
Well, the model isn't ignoring it, right? The model assumes the AI supercycle is just a temporary windfall, not a permanent baseline.
That's a good point.
And that deep psychological divide in the valuation metrics, it perfectly mirrors the massive debate happening over on the Your Value Investing subreddit right now, because the market is absolutely terrified of history repeating itself.
Oh, I was reading through that specific Reddit thread, and the bears are vicious right now.
I can imagine. What's their main argument?
They point out that memory is historically the most notoriously cyclical sector in all of technology. It goes through these massive booms and then aggressive, devastating busts. One user actually brought up the golden rule of trading memory stocks. They said you usually buy cyclicals at a high PE and you sell them at a low PE.
Which feels completely counterintuitive to anyone trained in traditional value investing.
It really does. But it makes sense when you think about it. When a cyclical stock has a remarkably low PE, like Micron's forward 9.6, it's because the earnings, have artificially peaked due to a temporary shortage.
Right, the denominator got huge.
Exactly. So the market knows those earnings are a mirage and they're about to fall off a cliff, dragging the price down with it. These bears argue the current $100 plus EPS estimates are just being pulled forward because every single hyperscaler ordered chips at the exact same time.
A classic bottleneck panic.
Yeah. One user literally asked, are data centers going to build a mountain of chips and just swim in them? Like, what happens when Microsoft and Meta decide they finally have enough servers?
The bears are relying on the ironclad rule of commodity markets. When supply finally catches up to demand, the price drops to the marginal cost of production. It has literally happened in every single memory cycle for the last 30 years.
But the bulls on the thread are arguing this time is fundamentally different. Their entire thesis boils down to two words: AI forever.
AI forever.
Yeah. They argue that past cycles were driven by consumer demand, people upgrading their PCs or buying the new smartphone, and those consumers, they tap out. But today, the buyers are the richest, most capitalized companies on the planet, and they are locked in an absolute existential arms race.
Right, it's a survival game for them.
Exactly. Microsoft cannot afford to stop buying servers, because if Google builds a better AI model, Microsoft loses its entire competitive moat. So the bulls argue this creates a decade-long runway of just bottomless enterprise capital expenditure.
So what does this all mean? Who is actually right here?
Well, I think we have to push back on both sides here. You really cannot blindly accept the bear case because HBM is not standard DRAM. The bears are treating it like a standard, easy-to-make commodity.
Which we know it isn't.
Right. As we discussed with the vertical stacking, the physical bottleneck of manufacturing HBM means supply cannot easily flood the market to crush prices.
Yeah.
You can't just flip a switch and double production overnight. It's too hard.
Yeah, the physics just won't allow it.
But you also have to challenge the bulls. Yes, Microsoft and Meta have deep pockets, but they are publicly traded companies beholden to shareholders. If the downstream AI software, the actual applications running on these servers, if they don't start generating massive standalone profits soon, Wall Street will eventually force those hyperscalers to slash their capital expenditures. The bottomless pockets do actually have a bottom.
That is the trillion-dollar friction point right there. And to see how Micron itself is navigating this tension, we have to look at what they're actively doing with their capital. Like, are they operating like a crash is imminent, or are they operating like AI is forever?
All right, let's follow the money.
If we look at the TrendForce report, Micron is ramping its fiscal year 2026 capital expenditures to over $25 billion.
$25 billion. Wow.
And for context, they spent $13.8 billion in fiscal 25. So they are nearly doubling their capex in a single year.
That's a staggering commitment of capital. Where exactly is that $25 billion going?
They are building entirely new megafabs. They have a massive facility going up in Idaho with output slated for 2027. And they are breaking ground on an unprecedented $100 billion project in New York with initial output expected by 2028.
A $100 billion project.
Yes. And they are actively leveraging the U.S. government to do this, too. They secured up to $6.4 billion in direct funding from the HPS Act.
Building fabs that won't produce a single wafer of silicon until 2027 or 2028. I mean, that is the ultimate expression of confidence in the AI forever narrative.
It really is. But wait, here's where the narrative shifts again. During their earnings call, they revealed something that completely alters the cyclical argument.
Oh, what did they say?
To offset the massive financial risk of building $25 billion worth of new capacity, Micron just signed its first ever 5-year strategic customer agreement.
A 5-year contract. For memory.
A 5-year legally binding contract for memory. And this isn't just about outputting more chips either. Pulling from their 2025 sustainability report, they are heavily pushing their LPCMM2 technology as part of this.
The LPCAMM2 module is critical to understand here, especially regarding the long-term enterprise demand.
Right, because it offers up to 80% standby power savings for AI PCs.
80% power savings is massive for a data center or an enterprise fleet.
It's huge. And the way it achieves that is brilliant. Standard laptop memory uses a modular SOTODEM slot interface. It takes active power to push the signals across the motherboard traces all the way from the memory to the CPU.
Right, the physical distance drains power.
Exactly. LPCMM2 completely redesigns that architecture. It condenses the memory and mounts it directly closer to the CPU, and it has an integrated power management IC right on the module itself.
Oh, smart.
Yeah. The physical distance is shorter, the signal integrity is stronger, and the standby power draw essentially vanishes. So Micron isn't just selling more chips, they are aggressively lowering the total cost of ownership for their customers through extreme power efficiency, while simultaneously locking them into half-decade contracts.
If we connect this to the bigger picture, the 5-year strategic customer agreement is the absolute most important detail in all of these sources. If you truly grasp the implications of that, it changes how you view the entire semiconductor sector.
I completely agree, but help me understand the enforceability here. Because to me, it sounds like they are trying to take a highly volatile hardware commodity and transform it into a predictable software as a service subscription.
That is exactly what they were trying to do. And TrendForce knows that Samsung and SK Hynix are desperately trying to do the exact same thing right now. The entire industry is trying to artificially flatten the boom and bust cycle. These multi-year contracts are essentially take-or-pay agreements. They lock in guaranteed volume and pricing for up to half a decade.
But are those contracts actually bulletproof? I mean, if we hit a brutal recession or if the hyperscalers realize their AI models are bleeding money, are they really going to honor a multi-billion-dollar hardware contract? Or will they just, eat a massive break fee and walk away?
That is the great unknown. Historically, in previous down cycles, major customers have absolutely forced renegotiations. They simply refuse to take shipment, or they threaten to pull all future business unless the memory supplier drops the price.
So the contracts aren't always set in stone.
Right. The legal contracts often bend to the economic reality of the giants holding all the leverage. However, the memory manufacturers believe that because there are really only 3 major players left in the world, Micron, Samsung, and SK Hynix, the suppliers finally have the leverage to actually enforce these agreements.
Oh, interesting.
Yeah, if Microsoft breaks a contract with Micron today, they can't just run across the street to Samsung because Samsung's capacity is already completely sold out. It is a massive game of high-stakes chicken.
Which brings us to the actual war for market share. Because Micron is not operating in a vacuum here. They are going head-to-head with the South Korean powerhouse, SK Hynix.
Right, the other titan in the room.
And by the way, SK Hynix also just recently crossed that $1 trillion valuation mark.
It's crazy how fast they got there, too.
Yeah. According to the Benzinga competitor analysis, SK Hynix currently holds the absolute crown in the AI space. In the third quarter of 2025, SK Hynix controlled roughly 57% of global HBM revenue.
57%, that's a monopoly-level number.
Almost, yeah. And Micron only held about 21%.
That is a dominant lead for Hynix in the most lucrative segment of the entire tech sector right now. It is a massive moat. And you see it reflected in the longer-term performance, too. SK Hynix boasts a 1,624% return over the last 5 years.
1,624%, my goodness.
Yeah, easily beating Micron's 2,017% over the same period. And despite that massive run, SK Hynix is currently trading at a forward PE of just 6.1.
Which makes Micron's 9.6 look expensive.
It really does. Hynix bet heavily on HBM years ago. They partnered closely with NVIDIA really early on, and they completely caught Micron flat-footed during the initial AI explosion.
They absolutely did. Micron essentially skipped an entire developmental generation of HBM to try and leapfrog later, and that left them with very little actual market share when the OpenAI ChatGPT moment suddenly happened.
Here's where it gets really interesting, though. The Benzinga data shows Micron is furiously closing that gap. Wall Street expects Micron's EPS to surge 906% year-over-year next quarter.
906%? That's absurd.
While SK Hynix is only expected to grow EPS by 549%. Furthermore, Micron announced they have already completely sold out their entire 2026 HBM supply. Every single stacked chip they can successfully manufacture next year is already spoken for.
See, selling out your supply is impressive, sure, but it doesn't necessarily mean you are stealing market share if the overall pie is just getting exponentially larger.
That's a fair point.
The actual battle isn't for 2026 anymore. The true war between these two giants revolves entirely around the upcoming transition to HBM4. Ah, the next generation of the architecture.
Exactly. HBM4 requires directly integrating the memory controller logic right onto the base die of the stack. It is exponentially harder to manufacture than current generations.
And it was already brutally hard.
Right. Now, SK Hynix has the entrenched relationship with NVIDIA and the established manufacturing rhythm. But Micron is aggressively leveraging its geopolitical position here. They are the only US-based manufacturer in the Big Three.
Oh, the GPS Act money.
Yes, that $6.4 billion in GPS Act funding isn't just free money. It is the U.S. government strategically ensuring that the most critical component of AI infrastructure is actually manufactured domestically.
That's a huge tailwind for them.
It is. If Micron can use that capital and those new fabs to perfectly nail the HBM4 transition, the independent patent analysis suggests the technology gap between them and Hynix could evaporate entirely.
So it is effectively a two-horse race for the absolute future of artificial intelligence hardware.
It is, and the stakes couldn't possibly be higher. Which really brings the entire conversation back to you, the listener, trying to navigate this crazy landscape. When you see Robinhood flashing a buy rating, and you look at a seemingly cheap forward PE of 9.6, you cannot just view that number in isolation.
You have to look under the hood.
You really have to synthesize the churning complexity underneath it. I mean, we did the math. You have traditional 10-year DCF models screaming sell because the stock is trading at a massive premium to its calculated intrinsic value. But then you have Wall Street analysts screaming buy because they believe AI breaks the traditional DCF models completely.
The rules are being rewritten in real time.
Exactly. You're watching a company that is up over 800% in a year, spending $25 billion to build megafabs, and trying to rewrite the fundamental laws of cyclical commodity pricing through these unprecedented 5-year sauce-like contracts. There's absolutely nothing simple about this setup.
High risk, high reward doesn't even begin to cover it. It is a binary outcome on a macroeconomic scale. And I want to leave you with one final thought to mull over as you digest the sheer scale of these numbers.
Lay it on us.
We spent a lot of time discussing that $25 billion CapEx spend. Micron is laying concrete and installing multi-million-dollar lithography machines in Idaho and New York right now. Those factories will not produce any revenue until 2027 and 2028. Yes, they signed 5-year contracts to protect that investment.
Right, the structural shock absorbers we talked about.
Right. But what happens if the downstream AI software bubble actually pops? The hyperscalers are spending hundreds of billions on data centers to train these models. But if enterprise customers and everyday consumers refuse to pay $30 a month for AI subscriptions because the software just isn't generating enough real-world productivity,
The ROI for those data centers vanishes.
completely. If the funding dries up and the hyperscalers are suddenly bleeding cash, will those 5-year contracts truly hold up in federal court? Or will they be renegotiated to pennies on the dollar, leaving Micron holding the bag on the most expensive, state-of-the-art empty factories in American history?
That is the trillion-dollar question. And it is a genuinely terrifying possibility to consider if you're holding the stock. Thank you so much for joining us on this Time and Market Deep Dives. Keep digging into the fundamentals, stay curious, and always keep questioning the consensus.